Picture two men. Same city. Same year. Same net worth on paper, about $40 million each. The first man sells his company. He worked 30 years for it. Built it from nothing. And when the deal closes, he walks away with a wire transfer that changes his life. He cries in his car in the parking lot of his attorney's office. He deserves every penny. Then the bill comes. Federal capital gains tax. State tax. Net investment income tax. When the accountants finish their work, he is paid just under $16 million to the government. Gone. In one transaction. He still has $24 million, which by any measure is extraordinary. But $16 million that he built, that he risked, that he sacrificed weekends and relationships and sleep for handed over before he could even move it to a new account. The second man has $40 million too. Except his $40 million is sitting inside appreciated stock in a company he co-founded. He does not sell. He calls his private banker instead. His banker arranges a loan, a portfolio line of credit, using the stock as collateral. He borrows $3 million at an interest rate slightly above prime. The money lands in his personal account within days. Clean. Liquid. Ready to spend. He buys a vacation home. He funds his lifestyle. He makes investments. His tax bill for the year? Nearly zero. Now here is the part that will stay with you. Both of these men are following the law perfectly. There is no fraud. No offshore scheme. No loophole in the criminal sense. One man simply learned a different set of rules. And the other never knew those rules existed. This video is about those rules. Reframe. This isn't about tax evasion. It isn't about doing something illegal or morally questionable in some shadowy offshore account. This is about the structural design of the American tax code and how it was built, whether intentionally or not, to work completely differently for people who hold wealth versus people who earn income. Most people spend their entire lives optimizing for income. They negotiate salaries. They chase raises. They pick up freelance work. They work overtime. And every single dollar they earn gets taxed the moment it arrives. Before they can spend it, before they can invest it, the government takes its cut. The wealthy operate on a fundamentally different axis. They don't optimize for income. They optimize for wealth. And wealth, under the current tax code, is treated with extraordinary gentleness compared to the paycheck you receive every 2 weeks. When you understand why, the entire financial system starts to look different. Promise. I'm going to show you the exact mechanics behind what's called the buy, borrow, die strategy, the framework that allows some of the wealthiest people in America to accumulate billions, live lavishly, and pass generational wealth to their children while legally paying income tax rates that are often lower than their secretary's pay. I'm going to show you why this happens, how it works step by step, and, critically, what parts of this framework are actually accessible to ordinary people and what parts are structural advantages that may never reach you. By the end of this, you will never look at a paycheck, a tax return, or a news story about billionaire tax rates the same way again. Rule 1. The tax system is not designed around fairness, it's designed around realization. Here is the foundational idea that everything else rests on. The United States tax system taxes income when it is realized, not when it exists. What does that mean? If you own a stock worth $10,000 and it grows to $50,000, you owe zero taxes on that $40,000 gain. Why? Because you haven't sold it. In the eyes of the IRS, that gain does not exist yet. It is unrealized. It is a number on a screen. The moment you sell, the moment you realize the gain, it becomes taxable. This sounds like a technical accounting distinction. It is actually one of the most consequential policies in the entire tax code. Because here is what it means in practice. A person can accumulate extraordinary wealth, billions of dollars in appreciated assets, and owe absolutely nothing on that accumulation for decades. Sometimes forever. Jeff Bezos, Elon Musk, Warren Buffett, their wealth is not cash sitting in a savings account. It is equity. Stock. Ownership stakes in companies whose value grows every year. That growth is invisible to the IRS until the moment of sale. For ordinary workers, this distinction barely matters. You earn a salary, it's income, you pay tax immediately. The realization principle gives you nothing. But for asset owners, people whose wealth comes from things they own rather than labor they perform, this principle is the master key to the entire strategy. Rule 2. Capital gains are taxed at a lower rate than your salary, by design. Now let's say you do sell. Let's say you've held an asset for more than 1 year and you sell it for a profit. That profit is called a long-term capital gain. And the federal government taxes it at a maximum rate of 20%, plus the 3.8% net investment income tax if your income is high enough, bringing the effective ceiling to about 23.8%. Compare that to ordinary income tax, which tops out at 37%. So even when wealthy people do pay taxes on their investment gains, they pay at a structurally lower rate than a high-earning doctor, lawyer, or senior employee who earns their money through work. The justification for this has been debated for decades. Proponents argue that lower capital gains rates incentivize investment, encourage entrepreneurship, and prevent double taxation of corporate earnings. Critics argue that it fundamentally subsidizes wealth over work, that a hedge fund manager who earns $200 million a year through investment profits pays a lower tax rate than the nurse who earns $120,000. Both arguments have merit. But the policy is the policy. And understanding it is not optional if you want to understand how money actually works at the highest levels. But here's what most people miss. Even the 23.8% rate is largely irrelevant to how the ultra-wealthy actually operate day to day, because they've found a way to access the value of their assets without ever selling them. Which brings us to Rule 3. Rule 3. Borrowing is not income, and that changes everything. This is the center of the entire buy, borrow, die framework. This is the rule that, once you understand it, makes everything click into place. When you borrow money, that money is not taxable income. Read that again. If a bank hands you $1 million in the form of a loan, you owe zero taxes on that $1 million. Because it isn't income. It's debt. You have an obligation to repay it. In accounting terms, it doesn't enrich you, it just shifts a liability onto your balance sheet alongside an asset. Now apply this to the ultra-wealthy. You own $100 million in appreciated stock. You don't want to sell it because selling triggers a massive capital gains tax bill. Instead, you walk into your private bank, or in many cases, they walk to you, and you use that stock as collateral for a loan. The bank lends you, say, $10 million. You can spend that $10 million on whatever you want. A home, travel, investments, funding a lifestyle. Tax out on that $10 million? Zero. None. The IRS has no claim on borrowed money. And the interest you pay on the loan? That's often deductible in certain circumstances, particularly if the proceeds are used for investment purposes. This is the borrow phase of buy, borrow, die. And it is entirely legal. It is the same principle that allows you to do a cash-out refinance on your home without paying tax on the cash you receive. Scale that concept up by several orders of magnitude, and you have one of the primary financial tools of the ultra-wealthy. Rule 4. The loan gets repaid, but not by selling the asset. Now the obvious question, if you borrow against your stock, don't you have to repay the loan eventually? And when you sell to repay it, don't you trigger the capital gains tax anyway? Sometimes. But not always. And this is where the strategy gets more sophisticated. First, the wealthy often repay these loans not by selling the underlying asset, but by taking out new loans. They roll the debt. If the asset is continuing to appreciate, which, for a successful company founder's stock, it often is, the collateral grows faster than the debt. They borrow against new value to cover old obligations. Second, the interest rates on these loans are often quite low. When you have $50 million in stock at a major private bank, your borrowing cost might be prime rate plus 0.5%. Historically, this can be anywhere from 3 to 7% depending on the rate environment. If your assets are growing at 10 or 12% annually, which the broad stock market has historically done over long periods, you are essentially borrowing cheap money against appreciating collateral. The math can work in your favor for years, sometimes decades. Third, and this is the part most people never hear about, there is a mechanism at the end of life that wipes out the capital gains tax entirely, which is Rule 5. Rule 5. The step-up in basis at death. the tax code's greatest gift to inherited wealth. This is the die in buy, borrow, die. And it is arguably the most powerful and least discussed element of the entire strategy. Here is how it works. You buy 1,000 shares of a company at $10 a share. Over your lifetime, those shares grow to $10,000 a share. Your original investment of $10,000 is now worth $10 million. You have an unrealized gain of $9,990,000. If you sold those shares, you would owe capital gains tax on that nearly $10 million gain. You don't sell. You hold. You borrow against the shares to fund your lifestyle. You live well. You die. At the moment of your death, the IRS steps up the cost basis of your shares to their current fair market value. Your heirs inherit those shares not at your original cost of $10 per share, but at the current value of $10,000 per share. The $9,990,000 gain, accumulated over your entire lifetime, is permanently erased for tax purposes. Your heirs can sell the shares the day after your funeral and owe zero capital gains taxes. The entire appreciation, the full lifetime of growth, passes to the next generation completely free of capital gains tax. The loans you took out during your lifetime get repaid from the estate. The assets get stepped up. The tax disappears. This is not a loophole in the sense of an accidental legislative oversight. It is a feature of the tax code that has existed for decades. It has survived countless administrations of both parties. And it is one of the primary mechanisms by which generational wealth compounds across lifetimes without the tax friction that ordinary workers face on every dollar they earn. It gets worse. Or more accurately, it goes deeper. Rule 6. The wealthy pay for financial infrastructure that ordinary people can't access. There is a reason that the buy, borrow, die strategy sounds straightforward in theory, but isn't commonly used by the middle class. It requires infrastructure that most people simply don't have access to. Private banking relationships. Securities-backed lines of credit require significant asset minimums, typically $1 million or more, and the terms only become genuinely advantageous at $5 million, $10 million, or higher. Sophisticated tax and legal counsel. The interplay between estate planning, trust structures, charitable vehicles, and borrowing strategies requires attorneys and CPAs who specialize in ultra-high net worth planning. These professionals charge accordingly. A comprehensive estate plan for someone in this category might cost $50,000 to $100,000 in legal fees. And it needs to be maintained, updated, reviewed. Trust structures. Many wealthy families don't hold assets in their personal names at all. They use grantor trusts, intentionally defective grantor trusts, dynasty trusts, family limited partnerships, each of which has specific tax treatment and requires careful administration. These structures allow assets to grow outside of taxable estates, further compounding the advantage. The ordinary investor who reads about buy, borrow, die, and tries to replicate it with a $200,000 brokerage account will find that the margin rates available to them are far less favorable, the borrowing limits are more constrained, and the tax planning infrastructure simply isn't built for their situation. This is not a reason to ignore the principles. It is a reason to understand the full picture, rather than believing that one article or one video unlocks a billionaire's playbook for anyone with a laptop. Rule 7. Carried interest is one of the most controversial tax advantages in finance. Before we go deeper into the structural mechanics, we need to talk about a specific tax treatment that affects a very specific group of extremely wealthy people, and that has been at the center of political debate for 2 decades. Carried interest. Private equity fund managers, venture capitalists, and hedge fund managers typically earn their money in 2 ways. A management fee, usually 2% of assets under management, and a performance fee, often called carried interest or carry, which is typically 20% of profits generated for investors. The management fee is taxed as ordinary income at the highest rate. The carried interest, which can represent tens or hundreds of millions of dollars for successful fund managers, is taxed as long-term capital gains. At 20%, not 37%. The private foundations are a more complex version used by the wealthiest families. The Rockefellers, The Gateses, the Waltons each has used foundation structures that simultaneously serve philanthropic purposes and preserve family influence over significant pools of assets, in some cases for generations. Charitable remainder trusts allow you to transfer an asset to a trust, receive income from the trust during your lifetime, take a partial charitable deduction, and have the remainder passed to a charity of your choice. The trust sells the asset without capital gains tax and can invest the full proceeds, generating larger income streams than you'd have received selling the asset yourself and reinvesting after taxes. None of this requires bad intentions. Many wealthy people are genuinely philanthropic. But the tax advantages of charitable giving at the highest levels are substantial and largely unavailable to people who give through smaller, simpler means. Rule 9. Timing and jurisdiction are tax planning tools. Ordinary workers rarely have the ability to choose when they receive income. Your salary arrives on a schedule. Your bonus comes when your employer decides. Your tax situation is largely determined for you. The wealthy have substantial control over the timing of their income. And timing is a tax planning tool. Capital losses can be harvested to offset capital gains, selling losing positions to reduce the tax owed on winning ones. This practice, called tax loss harvesting, is available to anyone with a brokerage account, but the scale and sophistication of how it's executed at the highest wealth levels is qualitatively different. Some fund structures are specifically designed around systematic tax loss harvesting. Income can be accelerated or deferred based on anticipated changes in tax law. If rates are expected to rise, realizing gains today at a lower rate is rational. If rates might fall, deferring income makes sense. Geographic arbitrage, choosing to live in states with no income tax, like Florida or Texas, is a real strategy used by high-income and high-net-worth individuals. Some states have pursued wealthy residents who claim to move while continuing to spend significant time in higher tax states. California famously has an aggressive approach to non-residency claims. At the international level, some structures involve holding companies in jurisdictions with favorable tax treaties or low corporate rates, though this area has seen significant tightening under OECD initiatives targeting base erosion and profit shifting. Rule 10. Real estate is a tax-advantaged asset class that ordinary people underestimate. Real estate deserves its own rule because the tax treatment of real estate income is genuinely unusual, and unlike the most extreme wealth strategies, it's partially accessible to people of much more modest means. Depreciation is the key concept. When you own investment property, the IRS allows you to deduct the depreciation of the building, not the land, just the structure, over a set schedule. Residential property depreciates over 27.5 years. Commercial over 39 years. This means that a rental property generating significant cash flow can show a paper tax loss due to depreciation, even while the actual underlying property is appreciating in value. You receive income. The IRS sees a loss. Under certain circumstances, that loss can offset other income. Real estate professionals, a specific tax status with particular requirements, can use these paper losses even more aggressively. Then there's the 1031 exchange. When you sell one investment property and reinvest the proceeds into another qualifying property within specific timelines, you can defer the capital gains tax indefinitely. You can roll gains forward from property to property, building real estate wealth over decades, and once again, if you hold until death, the step-up in basis eliminates the accumulated deferred gain entirely. This combination of depreciation deductions, leverage, appreciation, income, and the step-up at death makes real estate one of the most tax-advantaged investment classes in the code. And while the ultra-wealthy use it at massive scale, versions of these advantages are accessible to ordinary investors who own rental properties, even a single one. I'm not done yet. Rule 11. The payroll tax is regressive and almost nobody talks about it directly. Here is a tax that almost never appears in conversations about the wealthy paying less. It should. Payroll taxes, Social Security and Medicare, apply at 15.3% on earned income up to the Social Security wage base, which in recent years has been around $160,000. Above that threshold, only the 2.9% Medicare portion continues, with an additional 0.9% surcharge above certain income levels. The critical word is earned. Payroll taxes apply only to wages and self-employment income. They do not apply to capital gains, dividends, rental income, or interest income. They do not apply to income earned through ownership. So a worker earning $80,000 in salary pays payroll taxes on every dollar. A hedge fund manager earning $80 million in carried interest and investment returns may owe little to no payroll tax on the vast majority of those earnings. This is a regressive feature, meaning the effective payroll tax rate is higher for lower earners in percentage terms and disappears almost entirely for the very highest earners whose compensation comes primarily from capital. Rule 12. Opacity is a feature, not a bug. Public companies must disclose financial information. Most individuals have no such obligation. The complexity of how the ultra-wealthy structure their finances is not accidental, it's functional. ProPublica published a landmark investigative piece in 2021 using leaked IRS data showing that some of the wealthiest Americans had paid remarkably low income taxes relative to their growing wealth. The story generated enormous attention because the data was previously invisible to the public. These individuals had done nothing illegal. Their advisors had simply constructed arrangements that were too complex, too opaque, and too individually tailored to be easily analyzed or reformed. Tax law is written in general terms. Implementation is specific. And specificity requires knowledge that costs money to acquire and maintain. This creates a compounding advantage. The more wealth you have, the more you can afford the expertise to preserve and grow it. The less wealth you have, the less access you have to that expertise, and the more you pay in effective tax rates relative to your net worth. The system is not designed to be legible to ordinary people, and that opacity serves certain interests very well. Rule 13. The wealth effect means the same percentage has a different meaning. Here is a psychological and mathematical reality that gets lost in abstract debates about tax rates. Losing 10% of your income when you earn $40,000 a year is categorically different from losing 10% when you earn $40 million a year. The numerical percentage is identical. The human consequence is completely different. The person earning $40,000 loses $4,000. That's groceries, a car payment, a month's rent in many cities. The loss is visceral. It touches daily life. The person earning $40 million loses $4 million. They have $36 million left. Their lifestyle, their security, their options, their ability to invest and accumulate further, essentially unchanged. This is not an argument for any particular tax policy. It is a mathematical reality that any honest conversation about tax fairness has to reckon with. Percentages are not the same as impact. And the progressive structure of the income tax was designed with exactly this logic in mind, the principle that a dollar matters more to someone who has fewer of them. The buy, borrow, die strategy is significant not just because it reduces tax rates, but because it allows the perpetuation of wealth at a scale that compounds indefinitely. What starts as a tax advantage becomes a multi-generational economic structure. Rule 14. What is theoretically available to you, and what isn't? Let's be direct about something. There is a genre of financial content that implies all of these strategies are available to anyone willing to learn. That with the right knowledge, anyone can do what billionaires do. It is not always honest. Here is what is actually accessible to ordinary investors. Tax-advantaged accounts. Your 401k, IRA, Roth IRA, these allow tax-deferred or tax-free growth. They're not glamorous, but the mathematical impact of compound growth with no annual tax drag is genuinely significant over a long horizon. Tax loss harvesting. If you have a taxable brokerage account, you can sell losing positions to offset gains. Some brokerages offer automated tax loss harvesting. The benefit is real, though the scale is limited by your portfolio size. Long-term capital gains rates. Simply holding investments for more than a year before selling qualifies your gains for the preferential long-term rate instead of ordinary income rates. This is available to everyone. Real estate depreciation. If you own investment property, the depreciation deduction is available regardless of your net worth. The 1031 exchange is available regardless of your net worth. Roth conversion ladders. Strategically converting traditional IRA funds to Roth during low-income years can reduce lifetime tax burden. Here is what is largely not accessible without substantial existing wealth: securities-backed lines of credit at favorable rates, private banking relationships, complex trust structures, private foundation vehicles, and the expensive professional infrastructure needed to maintain them. The honest takeaway is this: the principles matter at every level, but the advantages compound more powerfully the more wealth you have already accumulated. The tax code does not treat all wealth equally. Rule 15: policy is not static, but change is harder than it looks. Every few years, there is significant political momentum around reforming these provisions. A billionaire minimum tax, taxing unrealized gains above certain thresholds, eliminating the step-up in basis, reforming carried interest, restricting dynasty trusts. Some reforms pass at the margins. Most significant structural reforms do not. Why? Campaign finance. The people most affected by these reforms are often the same people with the largest capacity to fund political campaigns and lobbying efforts. This is not a conspiracy, it is an incentive structure operating exactly as one might expect. Complexity. Tax law is enormously complex, and each provision has constituencies, not just wealthy individuals, but farmers who hold appreciated land, small business owners who built value over decades, families who depend on real estate strategies. Reform proponents must navigate the difference between the Jeff Bezos step-up and the farmer leaving land to their children. Economic argument. There are genuine academic debates about the economic consequences of taxing unrealized gains, liquidity issues, valuation difficulties, effects on investment, and entrepreneurship. These arguments are sometimes made in bad faith by people who benefit from current law, but they're also made sincerely by economists with legitimate concerns. The result is that most reform proposals that would significantly affect the buy, borrow, die framework either fail to pass in modified form, or are challenged and rolled back. The structural advantages tend to persist across political cycles. Rule 16: the conversation you're having about money is probably the wrong one. Most people spend their financial lives optimizing for the wrong variable. They negotiate income. They chase a bigger salary. They celebrate a raise. And income is not irrelevant. You need income to live, to invest, to build anything. But income is the most heavily taxed form of financial accumulation. Every dollar you earn through work is subject to income tax, payroll tax, potentially state and local tax. It arrives already diminished. Wealth, meaning ownership of assets that appreciate, is taxed more gently, more deferably, and in some cases not at all. The psychological shift that actually matters is moving from an income mindset to an ownership mindset. Not because it immediately changes what's available to you, but because it changes what you build toward, what decisions you make with extra income, and how you think about the financial system you're operating within. The person who understands that $1 invested in an appreciating asset is treated fundamentally differently by the tax code than $1 earned in wages will make different decisions over time. Maybe they max their retirement accounts first. Maybe they prioritize building equity in real estate. Maybe they think differently about starting a business, which, if it grows, creates the kind of appreciated equity that the entire buy, borrow, die strategy is built on. The wealthy don't play a different game because they have more money. They have more money partly because they understood the rules of a different game first. Ending. Remember the two men at the beginning of this video. Both had $40 million. Both were successful. Both had worked hard, taken risks, built something real. The difference between them was not intelligence. It was not effort. It was not even luck, not entirely. It was the moment they encountered someone who explained a different set of rules. The first man knew how to build a business. He knew how to work. He knew how to deliver value. And he did all of those things extraordinarily well. But when the transaction was complete and the structure of the deal was set, he had optimized for the sale, for the income event, without fully understanding what would happen when the money arrived. The second man had at some point, at an early enough point that it changed his behavior, understood that the tax code responds very differently to wealth held versus wealth received. He had structured his ownership. He had cultivated banking relationships. He had an estate attorney he'd worked with for a decade. He had a plan that extended not just through his working years, but through the end of his life and into the generation that would follow him. One outcome cost $16 million more than the other. Not because the government was unfair to one and generous to the other, but because the system has two parallel tracks, one for income earners, one for wealth holders, and only one of those tracks sends you a bill the moment you succeed. Here is what I want you to take away from this. This is not a video about feeling cheated. It's not a video about politics. It is not a call to cynicism about a system you cannot change on your own. The structure is what it is. The code is what it is. Rage at it or accept it, it operates the same way either direction. What you can change is what you know. And what you do with what you know. The wealthy don't pay taxes like you do because they learned, at some point, that the rules work differently for assets than for income. They learned that holding is different from selling. That borrowing is different from earning. That death, structured properly, is not a tax event, it's a reset. Some of that is accessible to you right now, at whatever level of wealth you have. Some of it will require building toward first. But the most expensive thing you can do is live your entire financial life without knowing the terrain. The map exists. You just looked at it.